Hello, my name is Craig Tashjian with Fairway Independent Mortgage. We have a local branch here in Needham, Massachusetts, part of a national company, Fairway Independent Mortgage out of Madison, Wisconsin. We are a direct lender, not a mortgage broker. And what I'd like to show you today is a comparison of continuing to rent versus owning a new home. And the benefits of that. So in the first column here we have the rental column. Let's say the rent is $1,300 per month, $30 a month in other rental expenses, so $1,330 per month. If you had a mortgage based on, let's say a $300,000 purchase price, 5% down, that would be a $285,000 loan. 7-year adjustable, the rates are in the high 3s, low 4s right now. That's $1,320 per month. Mortgage tax insurance and mortgage insurance of about $584 a month roughly. Total payment of $1,900. Now you're probably saying to yourself, this is considerably more than if I were to continue to rent. But if you factor in a tax benefit, there's still a mortgage interest deduction, and I did this based on a conservative 15% tax bracket, $211 tax benefit, and then a principal pay down. How much principal would you be paying down? How much would you be paying down your loan on a monthly basis? Well, at least in the beginning, over $400 per month, and that would increase each month. So really, on a net basis, $1,264 is what your net payment after tax benefit and after principal pay down. Because your principal, you're paying yourself, you're paying off your loan. So over a short 5-year period, you would see that you would pay $81,000 in rent over the next 5 years, versus in the next 5 years you would accumulate $28,000 in principal over the next 5 years. So really the question is, can you afford to continue to rent and not buy? This is the best time to buy in the last 7 or 8 years in terms of home affordability versus the cost of renting. Cost of renting has been increasing, and as you can see, your equity increase, total equity over this 5-year period is $58,000, because that includes your initial investment. I used a modest 1% appreciation rate. Use the same modest 1% appreciation rate in rent. Rent has been going up faster than that, and as we know, in the last several years, the property hasn't appreciated, but I believe we have bottomed out, and we should see modest appreciation going forward. So what does this mean in terms of the long term? Most first-time buyers are looking at maybe a 5 to 7 year, 8-year horizon. If you were to continue to rent, leave your $25,000 that you had saved in the bank at a 1% return, that's about $27,000 over 7 years. If you were to purchase a home, when you look at the initial investment, plus the equity that you would accumulate, plus the modest 1% appreciation, that's a $93,000 net worth over 7 years, almost 2.5, 3 times of what your appreciation rate would be if you left your money in the bank. So what I'd like to propose to you is that if you would like further analysis of this, I'd be happy to do a rent versus own analysis on an individual basis, on a consultative basis. Answer your further questions, please give me a call if you find this valuable to you. And you can also fill out the form below, and I can get back to you as soon as possible. Thank you.